Here we are at day 3 of week 9, and our job today is to learn more about the 5 magic bullets and how we can use the 534 awesome oscillator in accurately counting the Elliott wave. We're going to look at a half a dozen charts or more, and we're going to put both of those together, counting the Elliott wave using the 534 oscillator and also the 5 magic bullets. So let's get on with it and have some fun today. And what we want to look at first is that bullets, the magic bullets in action. And we want to look at this chart, for example, and this is the same chart we were using yesterday. This is an S&P 500 chart that was a fantastic success with a great deal of profit going all the way up through here, and we were quite successful in predicting the exact top of it. And we used the 5 magic bullets. And let's look at how we did that. The first magic bullet is the target zone. The target zone came out to be right there, and the market ended up almost exactly to the tick in the middle of that projected target zone. And remember, that's the target zone we were talking about yesterday, where you take the price difference between the beginning of wave 1 and the end of wave 3, and then project that onto wave 4. So that's our first target zone. That's our first magic bullet, is the target zone. The next magic bullet is divergence, and notice that the price is going up continually, and the momentum is getting less and less on each price extension. In fact, here we had something that was very, very unusual. We had a quadruple divergence. Now, quadruple divergence takes 5 prices. Here's 1, 2, 3, 4, 5. And you only see a quadruple divergence once in a blue moon. A few times every year will you see that much. And that gave us a great deal of confidence that we were approaching the end up here with this divergence. So we had 2 of the magic bullets. We had the target zone, we had divergence, and we had another magic bullet, and that was we had a fractal right up here at the top. Not only did we have a fractal, but that fractal had a squat bar on that very day of the top. So we had 3 of our magic bullets in: the target zone, the divergence, the fractal, and we also had a squat. That top bar was a squat. So we have one more magic bullet that we must look at to make this picture really complete, and that is we must have a change in momentum. And that's exactly what we had here. On that top day, we had a change in momentum from up to down. So we suggested to people that they exit at the end of this bar. The next day was down, and it continued down for 6 days here. And on one contract basis, that loss from here to here was over $68,000. So hopefully that will give you an idea of how important it is to use these bullets. And when you have all 5 bullets, that almost always, almost invariably kills any trends. Let's look at that 534 oscillator in a little bit more detailed basis here. We count the Elliott wave from the 534 oscillator, not the price chart. The key thing to remember is that when counting the Elliott wave, and this is extremely important, you must have 100 to 140 bars in that wave that you're counting. If you don't have the correct number of bars, then what you must do is you must adjust your time frame to get that correct number of bars. Once you have the correct number of bars, the Elliott wave practically unfolds right there in your lap. Let's take a couple of examples. Let's say, for example, that we're looking at this bar chart, and we want to know what's happening inside here. That certainly isn't 140 bars. Now, this is a daily chart, so to get 140 bars in there, what we have to do is we have to go down to a 45-minute time frame. Now, at this point, we have, this is just over 100 bars. It's about 110 bars here. So the AO becomes absolutely accurate. And if we're counting this wave here, we want to analyze what that wave is. It may look like that's a 1, 2, 3, 4, 5. In fact, most people who count it using the price bars would say that's exactly the count. What we know is that is not the correct count, that this is wave 1, this is only wave 3. This is wave 3, 4 inside of 3, but this tells us that this third wave is not over. The market's going to come back down, most likely to either this point or this point, the previous 4th wave of the lesser degree, and then it's going to go higher. So we can adjust our trading strategy to that. It makes it accurate to count this wave right here. The key, again, is getting 100 to 140 bars in the wave count that you're counting. Now, the 534 oscillator is a very, very powerful tool, and there are 4 primary uses of that 534. One primary use is identifying the peak of wave 3, and that peak of wave 3 will always, always be a peak in the momentum. Now, what you see here is a peak, then it comes back down and it peaks again. This is a higher price. This tells you that this is the 3rd wave inside that 5-wave sequence, 1, 2, 3, 4, 5 up here. And this momentum, this peak, tells us that the corresponding wave count is a wave 3. We know that that's 3 of 3, and that's 5 of 3, because this did not go below 0. A second primary use of the 534 is determining the end of wave 4, actually when the minimum requirements for wave 4 have been met. Now, what I've done is enlarge this so that you can see that this wave 4 here, the oscillator just barely goes below 0.0. That's okay. In the last several years, the last 5 or 6 years, our staff has looked at literally tens of thousands of charts. And counting the Elliott wave, we have only found 2 errors in this. One was in a 15-minute cocoa chart, one was in a 10-minute sugar chart, and both of those were less than 5/100ths of 1 point. Both of those errors was that the wave 4 did not quite come down, but it came within 5/100ths of 1 point on this scale. And look at this scale down here. Here's 1,000. We're talking about less than 5/100ths of 1 point. So for all practical trading purposes, this indicator is basically infallible, because again, we've only found 2 errors in literally tens of thousands of charts. So the second job, or the second primary use of the 534, is to tell us when the minimum requirements for wave 4 have been met. Because if we're in a wave 4, we certainly don't want to trade this, because 85% of all of our whiplashes happen in wave 4. We want to wait until this crosses 0 before we even start to look for a place to go long or short again. The third use is the end of a trend. the momentum is looking for the end of a trend at the top of wave 5, and that always has divergence in it. And then the fourth reason, fourth primary use, is that it gives us a change in direction. And notice that this change in direction almost always gives you a preview of the price. We call this reading tomorrow's Wall Street Journal. And it's very important that you understand exactly how all of that works. Now, what I'd like to do is look at about 4 or 5 charts, and let's just look at those charts and see what we can learn from this indicator. We know that this is the top of wave 3 of 3. This is 5 of 3, so this is the wave 3 here. We know that this is the minimum requirements for wave 4. Here's another peak inside of the wave 5, and notice that we have divergence between the big wave 3 and the big wave 5 from here to here. And inside of wave 5, we don't really have enough bars here, but we still have divergence. We would have even more divergence if we had enough bars. If we were counting this this last wave up here, then we would have divergence, and the oscillator would go below 0 on wave 4. So here are our signals here. These are all 4 of them that we looked at again. Let's look at some practice charts now. What we know on this chart, for example, let's back up this chart. We went just a little bit too fast here. Let's back up on this chart. And here we have a big wave up here. We want to know what this is. We have 100 bars about to this point. So we know that this is 3 of 3. This is 5 of 3. So what's coming back is a 4th wave, and then it will go higher. Let's look at another chart to show you the downside. Here we have a downside chart, and notice that this looks like wave 3. If you look at the price chart, it looks like wave 1, 2, 3, 4, or 5 rather, and 1, 2, 3, 4, 5 inside of 5. So if you're looking at the price chart, you would probably come to that conclusion. But looking at this almost infallible indicator here, this is the peak. So we know that this is wave 3. So we're probably going to get a pullback because we have divergence, we have a change in momentum, we have a fractal, we have a squat, we have 5 magic bullets down here, but it's going to change into a wave 4. And if you were a long-term trader, you would still want to be short. You would not want to come out here because you positively know with over a 95% level of confidence that this low is simply not in. So there's an example of a downside, a bearish market. Let's look at another bearish market. This one is different. What we know here is, again, this is wave 3. It has just now fulfilled the minimum requirements for wave 4. This could not be 3 and this 5 because this oscillator, this awesome oscillator here is at its lowest peak at this point. Let's take another example of a down market. This one is different. We know this is not the 3rd wave down here. This is the 3rd wave because the peak happens here, and it does go above 0, signifying that that is wave 4. This is wave 5. So this is a very, very different chart than the one that we just looked at. Let's look at one more here. This one tells us that wave 3 is here, wave 5 is there, and this is another wave instituting here, and this is a wave 5 compared to this long wave here, because wave 3 will always, always have the peak. And that's it for about day 3 and wave 3 on week 9. We're going to come back tomorrow, and tomorrow what we're going to do is look at the 5 magic bullets in the market, and we're going to practice some more Elliott wave counting. So have a good night. Do all of your stuff you're supposed to do. We'll see you here tomorrow.